Quality really is a business characteristic, and frankly, a lot of other money managers say that they buy quality, right? But we think our approach to quality is very different.
We are interested in how sustainable the business model is of a company over long periods of time.
Companies that fit our definition of quality are rare.
These type of companies have the ability to weather through good economic times and poor economic times.
A lot of managers say they buy high-quality companies with healthy balance sheets and are very profitable. We go beyond those numbers and understand the qualitative character of the business that allows the company to generate that financial profile.
At Keen Anderson Rudnick, we are very different, and I think we take a private equity approach to the public markets. That really means research. It really means digging down deep into our companies.
We think of ourselves as business analysts and not market analysts.
We try to think like owners, and that mindset leads us to do things like walking a factory floor, talking to customers, or calling competitors.
By understanding the relationship between the qualitative attributes of the company and the quantitative output of the business, we're in a better position to assess the sustainability of the company.
Spend a lot of time focusing on the superior business models because over time it's the earnings that drive the stock price. It's the business results that drive the investment results, and that all comes down to the superior business model.
What we are looking for in our companies is a sustainable, superior, protectable business model.
It is so important to really understand the entire competitive landscape. And what I find when I meet with my peers who are analysts at other places is that they look at companies myopically. They don't always look deeply at the competitive landscape. They don't say to themselves, who is coming up behind this company? Who is interested in taking over this leading market share position? How is this company going to maintain this durable competitive advantage?
Sometimes we're attracted to a company by its financial results, and we do the work and we pass on that company for the very reason that we're unable to identify that business model behind those results. Again, being unable to make sure that those results will be sustained in the future.
Our investment time horizon is very different from many other managers. So when I'm considering an investment, I'm thinking about over the next 10 years, is this business going to remain prosperous? And based on the price that I'm paying today, what will my investment return look like? The average mutual fund turnover is 130%. Our portfolio turnover is less than a quarter of that. So that speaks to the attitude we have of investing in businesses and not trading stocks.
We have concentrated portfolios. We typically own about 25 to 35 names. Many of our peers will own far greater number of names. The reason we do that is that we want to concentrate on what we think are the very best companies that have the highest competitive advantages. We want to take a rifle shot approach as opposed to a shotgun approach, which is what most of our competitors do.
We believe that by having a high-quality portfolio where each company in and of itself has lower business risk, lower balance sheet risk, and lower profit risk, you overall mitigate the risk of the portfolio, despite the fact you only have 25 to 35 stocks. And the numbers really prove this out.
We've been in business for over 30 years, and the reason we've been able to stay in business for 30 years is we've evolved and met client needs over that time period. In our investment area, we're constantly trying to figure out how to do our jobs better, how to do it quicker with better information and make better investment decisions, because at the end of the day, that is the heart of our business, and that's what our clients hire us to do.